The Zacks rank, value, momentum, growth, and income all factor into Zacks rank buys.
Well, there seems to be some value in a couple of insurance companies that our value strategist Tracey Ryniec has uncovered for us, and she's here with me now to talk more about them.
Yeah.
It's kind of interesting. You wouldn't always expect to find value in insurance companies.
No, and people think they're boring. I mean, I'm in that camp too. I'm like, an insurance company, why do I care? There's all these more glamorous things to invest in, but now is a good time to be in insurance.
All right, so one is Chubb,
Yes.
right? Been around for a while, P&C insurer, that's property casualty.
Right, so they're on the property side. They were originally ACE, which is also a property insurer, and then they bought Chubb. They just closed on this deal in January. It was a $29 billion deal, so this is a big deal.
Yeah.
And basically it's doubling the size of their company, about a $52 billion market cap now. So they're going to be quite big in insurance globally. And, the insurance area has been good on the property casualty side. They see, increases in what's going on with their revenue, and this will create some real good synergies. So the analysts like it. There's some good value here. We're seeing a PE of around 12, and it has a price to book of under 3, which is what I look for. Mm-hmm. And then you can see with the estimates here, they are getting a boost off this last earnings report because the analysts do like what's going on.
Right.
There's not a lot of growth with this one, but that's okay if you're looking for value. They're basically going to keep around the same earnings this year as compared to last year, and then maybe 3% growth for the next year. But again, when you're getting a cheap stock, that's not the worst thing. You can see, and shares, like a lot of things that have happened in 2015, have sold off here. And even though the story's good, investors are a little nervous. You're getting a dividend yield.
Yeah, dividend investors will be real happy.
Right, 2.4%.
Yeah.
So, I like what I'm seeing with these insurance companies.
All right, another one is Unitedhealth Group, UNH, the ticker. They're one of the largest health insurers, right?
Yes, that's on the other side, the health side of things. And as we know, Obamacare has been a big boost to a lot of these companies because everybody's got to get insurance now.
Right.
They have seen enrollment go up about 40% in the last 5 years, so that's been boosting earnings. But they also have a lot of other good things going on with keeping costs controlled. They actually have 2 different segments. They have the health insurance segment, and just this last year, or I think maybe it was the quarter, revenues were up in that double digits. But their service side, which is where they do like pharmacy and they do other things for the medical industry on that side, that was up 40%. So combined for the full year, they saw revenues up 20%. And this is, again, an insurance company with revenues up 20%. There is value here. It's not quite as strong a value as with Chubb, but they're trading a little under 15 times with their PE. They do have a price to sales ratio under 1, which is what I like to look for.
Right.
And unlike Chubb, it is one of the rare companies that's a value with the growth. They're expected to grow earnings another 19% this year and another double digits in 2017 as those enrollment numbers stay up and, costs are contained. Things look good for them.
Decent dividend.
Yes, they're paying a little under 2%, so
Right.
not quite as good as Chubb.
But okay.
Yeah, you're getting something to hold on. But I did bring these couple of these charts in because I thought it was interesting. I looked at the 2-year charts between Apple and United Health Insurance because Apple's one of the glamour stocks, insurance isn't. But you can see, even though UNH is in the black, and that has kind of stalled out in the last year and a half, but it's still outperforming Apple quite considerably over the last 2-year period, mainly because Apple has also pulled back recently, but you're not getting shabby returns here. It has a 65% return over the last 2 years.
Yeah.
And so you might say, oh, Tracey, that's just the last 2 years. Apple's done better than that before. But I looked at the 5-year chart, and sure enough, UNH, 205% return over this time period. Apple's still impressive at 112, but it's almost double what Apple's return is. So I always just point these things out to tell investors there's more to investing than, the FANG stocks or the big glamour tech stocks, and you can make money in a lot of different areas. So it's always wise to keep an eye out for, being diverse in your portfolio. And even if you think an area is boring, as I sometimes do, that's sometimes where you get the best deals, and you can see really good returns.
Oh, Tracy, that's just a 5-year chart.
I know. Someone will send me a 10-year, I'm sure.
Own either one?
I do not.
All right, check out other stock information on our website, Zacks.com. You can link to it all right off the homepage with Tracy. I'm Terry Ruffalo.